Hi. Now you may wonder why I started on this search for a corporate life cycle. Part of it was driven by the fact that I was aging and I could see the same phenomenon play out at companies. But part of it comes from the search that everybody in every discipline has for one thing that you can use to explain everything. I mean, it's true in every discipline. If you look at the physical sciences, that search took the form of what is the one thing that can explain everything in physics, everything in chemistry. In the social sciences, the search is much more difficult because human beings don't behave in predictable ways. That said, though, we continue to search for a universal theory, something that can explain everything. And in the process, we can sometimes go off the tracks. In what ways? The first is we can overreach. Because we want a theory to explain everything, sometimes we use it to explain things that should not be explained. The second is once you've decided that a theory works, then you have bias. Every study you do will back up that theory, and I'm fully aware of this as I start on the search for a universal theory. Now, my discipline is finance, and it's a relatively young discipline. In fact, you can trace the history of finance as a discipline to the 1950s. It grew out of economics as an applied economic discipline, and not surprisingly, the first search for universal theory looked at economic theories. Harry Markowitz, and I would ascribe much of modern finance to the work he did starting in the work he did in the 1950s with Miller and Modigliani on corporate finance, came up with a way of explaining how markets worked. Basically, his search was built around a simple premise that investors choose between good and bad. Good he measured with expected returns. You want higher expected returns, and bad he measured with more risk. He started with the realistic view that investors are risk averse, and because they're risk averse, as they search for higher expected returns, they got to live with more risk. In fact, the original Markowitz principle looked at expected returns on stocks and their standard deviations and looked at what happened when you combine stocks and portfolios. At the risk of cutting short what was an extraordinary contribution, he came up with these portfolios that delivered better trade-offs in terms of risk and return than individual stocks. In fact, the Markowitz frontier, the efficient frontier, were those portfolios that delivered the highest expected return given any level of risk. So when he left, what he left behind was this notion that if you're an investor and you have a degree of risk aversion, you can find a portfolio that's best for you, that maximizes your expected return. A decade later, there was an add-on, a very simple add-on that changed the way we think about these efficient portfolios. You added a riskless asset to the mix. So rather than just think about what risky assets you should combine, he said, what if in addition to holding risky assets, you held something riskless? Seems simple enough, right? But it's amazing how much it alters. Hence was born the capital asset pricing model. Still within the same framework of expected returns being good and standard deviation in those returns being bad, risk. They found, at least based on the addition, Bill Sharp and John Lintner with the capital asset pricing model found that your most efficient portfolio involved a combination of just two investments, a riskless investment and a portfolio of every risky investment in the market. They called that the market portfolio. They argued that in the world they created, and that world required a lot of assumptions, every investor, no matter what their risk aversion, would hold some combination of the risk-free investment and the market portfolio. And they changed the way we think about risk and return in finance. So the original unifying theories went through this path of let's take an economic theory and let's see if we can use it to explain what's happening in markets. Now, I don't want to spend too much time on those theories because I want to move on to the second stage in finance. Finance was the original big data discipline. We've had big data before every other discipline had that advantage because we had market data, we had company data. And over time, we discovered that because the theories weren't explaining enough of what we saw in markets, that maybe data gave us the answers. This manifested best in a paper written by Gene Farmer and Ken French in 1990, where they looked at stock returns over an extended period, and they said, rather than using theory to explain why some stocks should earn higher returns than others, which is what the Markowitz principle and the CAPM tried to do, they said, let's let the data tell us what kinds of stocks earn higher returns. It is one of the most quoted studies in finance because they discovered in their study that two variables explained why some stocks earn higher returns and other stocks earn lower returns. The first was the market cap of the company. They found that small companies earned higher returns than large companies, with small and large defined in terms of market cap. Remember, they're looking at only publicly traded companies. The second factor that they came up with was the book to market ratio. The book, of course, is the accounting estimate of the value of a company, and market is what the market thinks the value is. And they found that low book to market companies or high price to book companies earned lower returns than low price to book ratio companies, market cap and price to book ratios. That gave rise to a whole host of factor seeking models. As our access to data is improved, people have discovered more and more factors. And by factors, I include things like market capitalization and price to book ratio that explain returns. And by last count, there are at least hundreds of factors. It's called the factor zoo that people claim explains differences in returns. I'm skeptical because, let's face it, if you have enough data and you keep looking, you will find things that are correlated with stock returns. But for better or worse, data-driven models were also trying to do what Harry Markowitz and the CAPM were trying to do, come up with a way of explaining what's happening in markets using what you're discovering in the data. So you start with theory-based models. We moved on to data-driven models. And along the way, there was a third path that people took. And you've got to credit Daniel Kahneman and Amos Tversky for coming up with this path where they applied the first principles of psychology to markets. They started with the recognition that markets are not run by robots, they're run by human beings, and human beings have behavioral quirks. I'm not going to call them irrationalities because they're built into our makeup. They argued that what you observe in markets is not always what the classic economic rational behavior is, which is built on robot-like behavior, but on human beings revealing their biases. Since then, behavioral finance, which is the body of finance that came from this marriage of economics and psychology, has become very much part of established finance. As behavioral finance is pushed out, trying to explain what markets do, there are two limitations that I see in behavioral finance's approach to finance. The first is we've expended tremendous amounts of resources in explaining past market behavior. So as you look at behavioral finance, a lot of it looks at past market behavior and then attributes it to some investor irrationality or behavior. The second is, as with data-driven approaches, if you're a believer in behavioral models, you're going to come up with more and more behaviors that you argue are different and use it to explain away market behavior. So you've got theory-driven models, you've got data-driven models, you've got behavioral models. Now, as I teach corporate finance and valuation, I've drawn on all three because there's a richness to each of these that I like, that I think explains market behavior. But I keep looking for something else that I can use in my classes to explain why companies behave the way they do, why investors behave the way they do. And I discovered it not in finance, but in strategy and management. There is this notion of a corporate life cycle that's been around a long time. This is by Dizes. He was a market strategist. He created this version of thinking about companies as moving through a life cycle. In his version of the life cycle, there were 10 stages where you started with, and he built it around very much of what you see in human life cycles. You start as a baby, you grow through, you become middle-aged, then, but he had lots of breakdowns along the way. Now, I started with this, but I realized it was too complicated, too unnecessarily complicated, in my view, to explain what was going on. Incidentally, I'm not the first one to use corporate life cycle in finance. Accountants have used the corporate life cycle without often using those words to explain why some accounting ratios work better at different stages in the life cycle. Why a return on invested capital might be great for a mature company but not work for a young or a declining company. Corporate governance researchers have used the corporate life cycle to explain why corporate governance challenges change as a company ages, arguing that the biggest challenges are at young companies and that governance improves as they mature. In valuation, the corporate life cycle, again, without using those words, comes into play in how we think about companies as they age. Their growth rates decline, they get to maturity, and then what happens is built around the life cycle. So I'm not going to claim originality here, but I very much made an explicit part of my, of the life cycle, a part of my classes starting about 15 years ago now, and they've taken a larger and larger role. Again, I'm not going to claim it explains everything, though I'm going to try to do that in this book, in this class. But I do think it explains a great deal of what we see out there. So let me explain my version of the corporate life cycle. It has 6 stages to it, and those 6 stages are going to become the prism through which I'm going to observe a lot of what I see in markets. A startup is like a baby. Right? Needs lots of care and attention. Basically, a startup, you have an idea that you want to convert into a business, and you think it'll meet an unmet need there and become a business. And then you become a toddler, a young growth company. You're trying to create some structure. You're trying to create a business model that works. Incidentally, the mortality rate in the corporate life cycle is much greater than the mortality rate in the human life cycle. 2/3 of startups don't make it to young growth, and many young growth companies don't become high growth. In high growth, you found a business model that works. You're growing your business out, and you're looking to see how much you can scale. Your challenge becomes a scaling up challenge. Can you take a business model that works on a small scale and make it a large scale? And if you succeed, you become a larger company. And as a larger company, you discover size starts to work against you in terms of growth rates. It's easy to grow $1 million company, much more difficult if it's a $1 billion company, even more so if it's a $10 billion company. I call that mature growth. You're still growing, but your growth rates start to come down. And then you become middle-aged. Perhaps even getting a little old, right? And who likes it? And whether you like it or not, your basic mode of operation becomes playing defense because everybody's coming after your business. And after middle age comes old age. And as with human beings, in old age, nothing good happens to you. Revenues start to shrink, your earnings start to drop off. And eventually, you go away. I know this notion of companies lasting forever is a glorified notion. In fact, there's an entire segment of business schools called, built around sustainability. An absurd notion in my view, and I'll talk about why. But this is my vision of a corporate life cycle. And I'm going to use it in 4 different aspects of business. I'm going to start with corporate finance, one of my favorite classes to teach. Saying, what's corporate finance? It's those first financial principles you use in running a business. In fact, I break my corporate finance class down into 3 big principles. The investment principle, where businesses have to decide what projects to take, what assets to invest in. And I'm going to argue that investment decision is going to shift, both in terms of criticality and how you approach it, depending on where you are in the life cycle. So from youth to demise. I'm going to look at the financing decision, where you look at the mix of debt and equity used to run a business and what kinds of debt. And again, argue that that's going to shift over the life cycle. And then I'm going to look at the dividend principle, where you're looking at how much cash you can return to your owners. And not surprisingly, that decision too will vary across the life cycle. I'm going to use the corporate life cycle to talk about how the investment, the financing, and the dividend decision play out within a business. And along the way, I'm going to talk about what I think is the biggest sin in business, not acting your age. Companies that choose to approach corporate financial decisions in ways that don't match up where they are in the life cycle. A young company trying to act like a mature company in terms of financing mix. A mature company trying to act like a young company in terms of how it invests. So that's where I'll start with corporate finance. Then we're going to move on to valuation. This is the second class that I teach. And in valuation, we know what drives the value of a business. It's the same for every business: cash flows, growth, and risk. And I'm going to argue that those cash flows, growth, and risk don't just come from an Excel spreadsheet, they come from a story. That's always going to be true. But I'm going to argue that the challenges of how you estimate cash flows, growth, and risk will shift depending on where you're in the life cycle. The criticality of your story is going to shift where you're in the life cycle. I'm not going to argue for new models and metrics for valuing young companies. In fact, I think that's a false start. I'm going to argue that the existing models and metrics work across the life cycle, but the challenges shift, and you've got to adapt to those challenges. So we talk about corporate finance, you talk about valuation. Then I want to talk about investing. I'm a great believer that every investor needs an investment philosophy. What's an investment philosophy? A way of thinking about markets, but where they make the mistakes that you're going to exploit and try to make money on. And if you look at the market, the variety of philosophies stretches the spectrum. You got value investors, you got growth investors, you got traders, you got arbitrageurs, you got information traders, you got momentum traders. It takes all kinds to make a market. And I know there are some who will argue that one investment philosophy is the best philosophy. I don't believe so. One of the things we'll talk about is how the investment philosophy you pick will take you to different stages of the life cycle. That value investors will tend to congregate around mature companies. That growth investors will go out looking for youth. Nothing good or bad about it, but it is something that has got to be factored in when you think about what philosophy is best for you. I'm also going to argue that the mindset you need, the skills you need to bring in, depend on where you are in the life cycle in terms of investing. A venture capitalist, to be successful, requires very different skill sets than a portfolio manager who looks only at mature companies. So as you go across the life cycle, the challenges investing change, and the kinds of investors who win will also change. At the end of the process, I hope you will accept my premise that there is no one best investment philosophy for everyone, but there is one best investment philosophy for you. And it'll depend upon what your skill set is, what you're comfortable with, and psychologically what you can deal with. Finally, I want to talk about the implications of the life cycle for managing. I know that there are entities out there, powerful entities in terms of spreading their message, that spread this mythology of a great CEO, the makeup of what makes for a great CEO. I'm going to push back and argue that there is no such thing as one prototype for a great CEO. I'm going to do this by looking at the kinds of management skills you will need to run a company if it's a growth company as opposed to a mature company. And I'm going to argue that those skill sets shift, that what makes for a great CEO in a young company will be very different than what makes for a great CEO in a mature company and what makes for a great CEO in a declining company. And you almost never will find one human being who can carry it all off. So as we look across the life cycle, we're going to look specifically at what makes for a great manager at each stage. I also want to spend time on the stage of the life cycle where managers have the most trouble managing declining companies, trying to pick the best pathway for the company. And let's look at the choices. You can be in denial. Lots of companies end up being in denial. So what decline? I don't see any decline. The second is acceptance, where you say, look, I'm in decline. I'm going to act like a company in decline. And the third is you're going to reach for reincarnation. Why? Because you become a hero. We'll talk about companies that have reincarnated and the lessons that you can generalize from those companies and the lessons you cannot. I hope you find this class and this book useful in your thinking. But thank you very much for listening, and I hope you come back for more.